Well, welcome again everybody. This is our annual tax planning video for the 2016 year. This is just a short video this year because there hasn't been a lot of significant changes from 2015 to 2016. And of course, this is not an exhaustive list of things to be done, and of course is not specific tax advice. If you've got any questions in relation to your specific circumstances, by all means contact your tax advisor here at WMS. So what are we looking at for 2016? Well, a consistent topic is superannuation, and of course contributions into superannuation may be tax deductible. Your concessional limits for which you get the tax deduction are capped, and for this financial year it's $35,000 for those of you that are 50 this year, and for those of you under 50 it's $30,000. So these amounts represents the amounts for which you get the concessional tax treatment. And as we say each year, for superannuation to be deductible, the contribution has to be received by your superannuation fund on or before 30 June. So don't necessarily wait until 30 June to send your payment off to your fund, as there's no guarantee through the banking system that it'll be received on that day. And just as a side note, for those of you on combined incomes of your taxable income plus your super contributions in excess of $300,000, you may be subject to additional tax on your contributions, so just be mindful of that, and if you've got any questions, contact your tax advisor. Now, the small business asset write-off concessions, they are available this financial year. Now, if you are a small business, so not an individual, a salary or wage earner, but a small business, you may qualify for the $20,000 instant write-off for asset purchases. So we're talking about items such as motor vehicles, computer equipment, plant and equipment, those types of things that would ordinarily be subject to depreciation. There's an immediate write-off there of $20,000 for those items. Now, the key to that is the small business test, which currently sits at businesses with a turnover of less than $2 million. So if your business qualifies under those rules, you may get the immediate write-off. If you happen to view our budget video, which was issued earlier this year by one of our partners, Stephen Holmes, you would note that the $2 million turnover limit is proposed to be increased to $10 million from next year. But be mindful that was just a proposal put forward by the government, and we've got an election coming up in the coming weeks, which may change that completely. We talk each year about capital gains tax. It's one of those taxes that potentially applies following the sale of an asset. The thing to be mindful of with capital gains tax is when you've got a capital loss, you may only offset that capital loss against a capital gain, not against your other income. So if you've made some capital gains this financial year already, you may review your asset portfolio, in particular some shares, to see if you're currently losing money on any of those, and if that is the case, you may seek to sell those assets before 30 June in order to crystallise the capital loss, which can then be used to offset against any gains you've made during the year. Now, the thing to be mindful of there, and we mention this every year, it's the actual date of the transaction. So the contract date is the relevant date for capital gains tax purpose, and not the date of settlement or when you receive the funds. So just be mindful on the timing of when you're actually making your gains and losses. Now, in addition to the timing, that raises another important point, is for the CGT 50% concession, which is available for assets owned more than 12 months. So just be mindful again when you're selling your assets, if you're approaching an ownership period of only around about a year, you may seek to hold off a little bit longer just to make sure that the sale date is actually more than 12 months from when you acquired that asset. We talk each year about bad debts, one of those unfortunate circumstances, and it's a part of doing business, but inevitably you have customers that from time to time don't pay for a variety of reasons. Where that has been the case, you can seek to write that off as a bad debt. Now there's some requirements there first, so you must have first brought that to account as income. You must have taken steps to recover the debt, and where those steps have failed, you then must write that debt off, totally out of your accounting records before 30 June. Now it's important to note again, and we mention this every year, the tax office do at times require you to provide evidence that you have in fact taken steps to collect or recover these debts, and that those steps have failed. So just be mindful of that when you're putting your records together and you're writing any bad debts off. Now with 30 June approaching, it's very common for businesses that sell goods to prepare and engage in a stocktake. It's quite often a painful exercise, but something that needs to be done. What you're really seeking to do there is to review all of your stock, and for any items that have been on the shelf for a long time, or they may be obsolete, they may be damaged, and there's no chance of sale, or no chance of selling them at a reasonably recoverable amount, you can write them off. Do so at the time of your stocktake. There are some differences between accounting and tax purposes for trading stock, but the general theme is if you're writing your stock down to a lower amount, that's going to help you reduce your taxable income and in essence pay less tax. The 30 June is also an important date for discretionary trusts, and particularly the trustees of discretionary trusts. There's a growing trend by the ATO to monitor the distribution resolutions made by trustees in respect of the income to be distributed to beneficiaries from discretionary trusts. One of the general requirements is that the trustee has assessed the income position of the trust and determined what distributions would be made for to beneficiaries, and have actually documented that by way of trustee resolutions. Now they need to be in place on or before 30 June, and if you haven't already heard from us in respect of that, you certainly will be soon. Now that's pretty much it for this year. As I said, there's not a lot of change from 15 to 2016, but we'll qualify that by saying, assuming there's a Liberal government in play come July after the election, some of the proposed changes that were in our budget video that was put out earlier this year will more than likely become law. So there's going to be some great opportunities in the 2017 year, which we will obviously be in touch with you about those. But just to wrap it up, just a couple of other quick points, just in respect of you're bringing your tax position down. Deferral of income is always a strong one. So any income you can push forward to another financial year effectively buys you 12 months worth of time before that's brought to account. Now examples of that may include where you've received income in advance from customers, maybe deposits on transactions that are yet to complete, or for income that you haven't yet earned and you're still subject to perform certain services prior to being entitled to those amounts. You certainly look at those positions, and obviously a natural one is to bring forward any tax deductions where possible. So for things like subscriptions, insurance, potentially any bonuses that might be employees may be eligible for, all those sorts of things, you can look like you're going to incur that expense in the near future. Perhaps looking forward to bringing that through this month. So that's the end of our video this year. As I said, not a lot of change between 15 and 16, but if you'd like to go back and refresh your memory on our 2015 video, there's a link on the screen now. And of course, as we say each year, if you've got any concerns at all regarding your specific tax circumstances, speak to your tax advisor here at WMS. Thank you.